Okay, so here's the big question. What happens if the stock market takes a big downturn just as you retire and begin taking money from your portfolio? Well, with all the recent market volatility, this is on a lot of people's minds right now. For new retirees, down markets can prove to be especially painful and maybe even lethal for your portfolio. There's actually a name for this. It's called sequence of returns risk. Simply put, it means that if you're seeing big losses in your portfolio early in retirement, while at the same time taking withdrawals from it, you're reducing the amount of assets available to you if and when the market eventually recovers. If this happens later in retirement, it's not quite as bad because you've got a shorter life expectancy by then and your money doesn't have to last quite as long. But early on, it could make big trouble for your portfolio. So what can you do about it? Well, naturally, you don't have any control over things like a falling stock market or bond yields or inflation, but you do have some options. Some good and some not so good. One option is to try to delay your retirement, but I gotta tell you, I hate that idea. And in many cases, you don't have any control over that anyway. You get laid off, you can't physically work anymore, the mental toll is just way too much, so let's forget that one. Another option is to simply settle for lower income during the years when the market is in a downturn. Well, that's another bad idea in my opinion. You shouldn't let the stock market dictate how much money you have in order to take a vacation or visit the grandkids, or even make sure your mortgage gets paid. That's crazy. A much better idea, I believe, is to portion off anywhere from 5 to 7 years of your portfolio into non-volatile assets, assets that are not affected by the stock market, and use that money for income. Another chunk of money can be set aside and placed in medium-term assets, which can be exposed to more risk, but which also gives you some measure of relative safety. And then obviously the remainder goes into longer-term assets like growth and value-oriented stocks. Since this money you don't really need for potentially 10 or 15 years or even more, the inherent risk may be mitigated over the course of many, many, many years. So the issue really isn't that you need to worry about retiring at the wrong time. Instead, it has everything to do with your strategy. It's all about managing your future, where your goal is to get your money to live longer than you do. Well, that's our goal too. So just give us a call. We're here to help.